Hi, my name is Darren Joseph from HEJ.Tax. We're the team that seeks to demystify the sometimes confusing world of international tax. And today I'm in Jakarta, Indonesia, a member of a larger practice called Moores Roland here in the Asia Pacific. And twice a year, we get together as partners from across 18 countries, 40 offices. I'm the chair of the tax working group, and it's an amazing opportunity to get together with my fellow international tax practitioners and share information on emerging trends in the international tax space. Today, I want to talk about where the ultra-rich spend their vacation, and to inform that discussion, I'm pulling data from Visual Capitalist, which is an amazing website. No affiliation. I just like the way they present complex data in an easily digestible fashion. So anyway, they've worked with Henley Partners, which is a recognized name in the investment migration space, to put together a data set that shows us vacation or holiday patterns for ultra high net worth individuals. So there are more than 25,000 Centi-Millionaires around the world, forming an elite club composed primarily of founders and heirs to family fortunes, right? So most of these individuals have more than 100 million in investable assets by definition. And as you would imagine, no one spends the entire year in one location. They have the ability and the privilege of splitting their time among several jurisdictions or several homes. Unsurprisingly, ultra high net worth individuals, they split their time in two places, the United States and Europe. That's it. Overwhelmingly, the United States, number one, Europe, number two. And in Europe, you're really looking at France and Portugal right now anyway. So the top three seasonal vacation spots for the ultra-rich are in the United States, which is Miami, the Hamptons, and West Palm Beach, Florida. Now, this obviously is not a shock to anybody, right? Remembering that the United States is home to the highest number of Centi-Millionaire residents in the world. And again, I like to emphasize the fact that this flies against the narrative online, which is that there's this huge gush as people rush to low tax jurisdiction. No, they do not. When you have a certain amount of wealth, it's all about that quality of life, not finding the most underdeveloped part of the world to go and hide. Understandably so, everyone is different. People have, different preferences, and some people do want to enjoy emerging markets, which is absolutely nothing wrong with that. But given a choice, what the data is telling us is that people prefer to go to arguably some of the most highly taxed and the most highly regulated parts of the world, because in return, it offers the best quality of life. So beyond the 10 US cities that constitute the top 17 Centi-Millionaire seasonal hotspots, we come across several French cities, including Paris, Nice, and Cannes, as well as Portugal's Golden Triangle, as well as Lisbon. It stands to reason that high net worth individuals may sometimes trigger tax residency by virtue of spending sufficient time in either the US or a European location of choice. And this is where tax planning comes into play. Obviously, in Portugal, we have the NHR. In Spain, you have the Beckham law or variants of it. Those who like other parts of Europe, there's res non-dom in Ireland, Malta, Cyprus, etc. But these are often temporary. They expire after a certain period of time. In addition, for those who are US exposed going to Europe, then bear in mind that your US tax advisors may only know US taxes. And so the planning and the strategy and the structures they have in place are optimized for the US, which would actually make you completely exposed when it comes to Europe, at least potentially so. Bearing in mind that US, generally speaking, is a much higher tax jurisdiction. So my point is you need to optimize for both. And it goes the other way as well. For European high net worth individuals who spend time in the US, your structures have been optimized for Europe, not for the US. And if you spend too much time in the US, the structures that you have may prove to be unhelpful when it comes to US taxes. And it's at this point I like to talk about trust. Now, somehow, I guess because of the media, people think a trust is like a panacea, this silver bullet, which resolves every tax problem you can have, which is often further from the truth. So generally speaking, we like to say that there are perhaps four types of trust models. There's American, there's a classic English, the Caribbean or offshore, and there's civil law jurisdictions which recognize trust. And typically, those are civil law jurisdictions which have signed the 1985 Hague Convention. So, my point in saying that is that the way a trust functions, for example, in the US, is not necessarily how it would work for that same private client when they spend time and become exposed to the tax system in the UK or in Italy or in Luxembourg or in France or in Spain, for example. One tool that US advisors often forget is foundations. In the US, foundations are mainly synonymous with nonprofits. For example, the Ford Foundation, the Carnegie Foundation, Rockefeller Foundation, and so on. But internationally, there are perhaps three types of private or family foundation models, which allow for asset protection, succession planning, and in some cases, tax optimization in the same way that trusts do in primarily common law jurisdictions. So you have the classic Liechtenstein Foundation, you have the Dutch Foundation, and you have common law jurisdictions that offer foundations. For example, certain Caribbean jurisdictions. Now, the challenge is that from a US point of view, the IRS is not very clear on how foundations are going to be taxed. So should they be treated like companies, like offshore companies? Should they be treated like a trust? It becomes a sort of a gray area, which is where you need help from international tax advisors who are familiar with these structures in the international tax context. Other planning tools that we see as being very efficient in an international tax context would be PPLIs, private placement life insurance policies, as well as SFOs, single family offices or multi-family offices, depending on the situation. It's a fantastic way of asset protection, succession planning, as well as tax optimization. My name is Darren Joseph, HCJ.tax.